Mortgage rates are dropping fast. Will potential homebuyers jump at newly cheaper payments, or will they wait to see if rates drop further before taking action? Mortgage rates are now at their lowest level in over a year. Last year at this time, rates were rising to peak at 8% in October, November of 2023. That late year rise in costs really slowed the housing market. And so all year so far in 2024, people were expecting rates to decline. I've been assuming that if they finally dipped below 6.5%, that we'd see a pickup in demand. We're now at that threshold. The 30-year fixed rate is under 6.5%. If it stays there, we will test my assumptions. One fear I have now is that it took so long to get here that maybe homebuyers have given up for the year and will wait to see what next spring looks like before entering the market again. Still, this affordability boost is good for any buyers in the market now. And we should be able to measure how demand changes over the coming weeks if rates stay at these new lower levels. Inventory rose pretty much as expected for the end of July week, with a gain of just less than 1%. About 6,000 more homes are on the market now than a week ago. That weekly percentage growth is probably slowing now at the end of the summer here. We will keep watching all the indicators to see if 2024 housing gets any rescue or if it's unsavable until next year. Such dramatic changes in financial markets guarantee some excitement coming. Are we past the opportunity for declining mortgage rates to help pick up demand for home sales in 2024? To track all the variables in more depth, our August webinar is now open for registration. So on August 15th, Thursday, we will be looking further ahead into the fall market with everything we can see now. There's a link in the description below to register. Click that to save your spot. At Altos Research, of course, we track every home for sale in the country, all the pricing, all the supply and demand, all the sales, all the changes in that data so that you can understand the housing market immediately as it happens. I'm Mike Simonsen. I'm the president of Altos Research. Let's take a look at the details of the U.S. real estate market for the beginning of August 2024. So there are now 684,000 single-family homes unsold on the market across the U.S. That's less than 1% increase for the week and is up 40% more homes than a year ago. Last year, as mortgage rates were rising late in the year, inventory was rising at like 1% to 2% per week in August and September into October, all the way into November. That was a very unusual time last year. Normally, inventory will plateau in August, start declining by late September, October. You can see the late 2023 inventory build in this chart in the bright red line. Especially note that September increase in inventory last year with a spike in mortgage rates. So if we get sustained lower rates this fall, will we return to the old seasonal patterns? So that's what I'm looking out for. I think we will see some slowing in the growth of inventory. So the slope is lower. Just under 1% growth this week, already down from 1.5% or 2% recently. The states that have been adding most inventory this year, for example, Texas and Florida, may be actually at their peak now, finally. So there are still unsold homes building in those markets, but it looks like we could be nearing the peak. So for example, in Texas, unsold inventory added just a fraction of a percent this week, a couple hundred homes on 28,000 unsold in Texas. Florida added less than 100 homes this week on 20,000 active inventory. And this is why, while we're currently at 40% more homes on the market now than a year ago, we still expect to finish the year at only 20% up over last year. So last year's late inventory build and this year should plateau sooner. So the current lower rates support that forecast. Most of the total inventory fluctuations have been on the demand side this year. When rates rise, demand slows, inventory grows. The supply of sellers, on the other hand, the other side of the inventory equation, of course. And when we look at the new seller, the new listings pace, there's no sign of a lot of sellers coming to the market. The new listings volume ticked down this week to 67,000 single family homes hitting the market unsold. There were another 14,000 new listings, immediate sales this week. So overall, only 4.6 more homes listed than last year at this time. 4.6% more homes listed now. That's not a lot of sellers. Slightly more than last year, but the seller pace is still very restricted. And this makes total sense, of course. If you own a home and you have a great mortgage and you have a lot of equity, very few people must sell. So if they're looking at weak demand, sellers can hold off. The dark line here is for this year, and it shows us here that there are still a lot fewer sellers than in any previous year except 2023. And there's no sign of that changing. The dynamic is going to be very important to watch, though, over the next year. Does unemployment finally rise? The world's been expecting a U.S. recession for like 2 full years now. And if it finally hits us, will American homeowners want to sell their homes? It seems like very few will. So until we see new listings pick up, we should expect a cap on inventory growth. The number of new contracts ticked up this week, a couple percent to 66,000, with another 13,000 condos started. So 66,000 single family homes and another 13,000 condo contracts started. So that's a good sign, ticked up this week. It's still very low, and in fact, fractionally lower, fewer home sales than last year. Condo sales are pretty significantly fewer than last year. Each of the last 2 years, as I've mentioned, faced sharply spiking mortgage rates in the back half of the year. So now we're in the opposite environment. So if cheaper money motivates a few buyers off the sidelines, then we should see it here. This is the count of all the contracts that start in a given week for home sales. And so these homes were on the market and are now in contract. And this year's dark line here is still lower than the last few years. There continue to be fewer sales now than a year ago. Is it about to break above and show some year-on-year growth? It could be if the cheaper money conditions hold. So that's what I'm watching for. Home sales in the back half of the last 2 years have been particularly weak. So we'll see if that trend finally breaks. So there are 379,000 single-family homes total in contract. That's down from last week. The end of the month closes a bunch of sales. There are a few percent more homes in contract pending now than last year. So while some of these contracts will fail, most will complete. So the pendings are an excellent proxy for home sales before the sales happen. The homes are spending about 37 days in contract, so these sales will close in August and September. The median price of those homes going into contract this week was just over $393,000. That's a downtick of 0.5% for the week and is about 3.5% higher than a year ago. So home prices always ease in the second half of the year, and we're in that cycle now. I continue to expect that any boost in the market, if rates stay lower, will be in the inventory numbers with less impact on prices for now. So if rates were to jump again, and they certainly could, then prices would be sensitive to the downside, like the pattern of 2022. In other words, buyer demand seems like it could be very easy to weaken and slower to strengthen in response to mortgage rate changes. I don't have a lot of evidence to support that assumption, but other than the pattern from 2022, which I've highlighted in the gray periods here. We know that demand is weak, that money is expensive, and that if the cost of money jumps again, demand can freeze. So it feels like to me our home price trend will stay in this 0 to 5% appreciation range through the end of the year. It's hard for me to see a scenario this fall where falling mortgage rates push prices notably higher. Though I could see that in the 2025 cycle if next year starts with significantly cheaper money. The price of all the homes on the market is hovering at $450,000, unchanged from last year. Sometime in the next few weeks, that number will start receding for the rest of the year. Home prices cluster around the big round numbers, so there are a lot of homes priced at $450,000, and the median falls right in that group. The price of the new listings this week is $412,000, which is up 3.3% over last year. And no matter how you measure home prices, they are up just a hair over 2023, and that pattern looks relatively stable. I continue to assume that the headline numbers, like the Case-Shiller index, will compress from 5 to 6% increases to under 5% as the year finishes. And while we'll be able to monitor any changes in homebuyer demand with the price reductions curve. Currently, 39.4% of the homes on the market have taken price reductions from the original list price. That's up 40 basis points for the week, which is on the same trajectory as recent weeks. We haven't seen any demand pickup as measured here yet, though we can confirm that the market isn't deteriorating. There are more homes on the market now with price cuts now than any recent year, but it's not accelerating. It's high, but it's not accelerating. So it's normal for price reductions to slow in August, plateau in September before declining for the holidays. This pace hasn't really slowed yet, but we can measure it if rates keep staying low, this will also turn lower. So as the market remained weak so far this year, I've been watching to see if price cuts would echo the 2022 slowdown. We've been talking about these sharply lower mortgage rates, of course, and if that motivates a few more buyers, we should see the price cuts decelerate from 40 basis points per week to maybe 10 or 20. So keep your eyes here to understand how much, if at all, buyers come off the fences. So it could be that this late in the season, there are not that many buyers motivated. Or maybe they're going to wait until the spring to see if rates are even lower then. That wouldn't surprise me at all. But even in that case, we probably won't see deterioration in prices the way we did in 22 and 23 in the fall. So I imagine this gauge will peak at about 42% of the homes with price cuts. If demand picks up, that'll be closer to 41 later in the year. And that's why we do this work each week. So mortgage rates stayed higher for longer than anyone anticipated this year. And maybe we finally turn the corner if we're lucky. For buyers and sellers, these conditions can change quickly. And they need to hear from you the data so that they know how to respond. You should join us at Altos Research. Go to altosresearch.com and book a free consult with our team. We will help you know how to talk about the market with your clients and prospects. There's a link in the description below to join us. Click that and let's get started.